With the introduction of new rules back in April 2015, it meant that you now have greater flexibility around how you can take your private pension plan. In this video, we'll look very specifically at Flexi Access Drawdown, UFPLS, which means Uncrystallised Funds Pension Lump Sum, and Small Lump Sum, Small Pots. And we'll have a think about the tax position of these various options. Taking taxable income is likely to have an impact on how other sources of income are taxed. So you need to think about how much you want to withdraw and how that withdrawal will be taxed. Pension flexibility that was introduced in April 15 provides those wishing to access their pension funds with a wide choice of vesting options. But which option do you select? Obviously, this is a decision that has to be thought through carefully, and hopefully this will provide some clarity on those options available to you. Now, Flexi Access Drawdown replaced Flexible Drawdown on the 6th of April 15. Using Flexi Access Drawdown, a pension holder can crystallise their pension fund, usually taking up to 25% of it as a pension commencement lump sum, PCLS, while the balance of the money continues to be invested. These are then known as crystallised funds. A pension holder can then choose to draw as much or as little of the crystallised fund as they desire. Withdrawals could be taken as a regular income stream or one or more lump sums. These withdrawals can be provided directly from the pension fund. Income tax will be chargeable on any withdrawals at the pension holder's marginal rate in the year of withdrawal, although it's very important to note that emergency tax may be applied to lump sums or the initial payments of income. So receiving withdrawal payments from a Flexi Access Drawdown account is a trigger event for the MPAA, Money Purchase Annual Allowance. As such, any ongoing pension contributions will be tested against the MPAA, and the MPAA is a reduction in the annual allowance from £40,000 to £4,000. It's important to bear in mind if there is a possibility that you would look to fund a pension plan in the future. We'll next think about UFPLS and how that varies from Flexi Access Drawdown. UFPLS very simply is a way of taking cash lump sums from a pension without purchasing a product. 25% of the UFPLS is normally tax-free and the rest is taxed at marginal rate. Importantly, with this, emergency tax will normally apply to the first payment, and we'll look at an example of this. So this is used where someone does not want to use or designate funds to drawdown, and they don't wish to buy an annuity. The government wanted people to have greater flexibility in retirement benefit choice. They did not want people to feel forced into taking pension income products, and they wanted them to be able to easily access funds as lump sums, with the theory that this greater flexibility may encourage more people to save for retirement. A skeptic, on the other hand, might suggest that there would have possibly been a bit of a tax windfall from the pension withdrawals for the government. So UFPLS brings more flexibility than was previously available. An uncrystallised funds pension lump sum can be paid as an authorised member payment to a member from uncrystallised funds held in a money purchase arrangement for that member. 25% is paid tax-free and 75% is taxed as pension income in the same way as pension paid under a registered pension scheme. This means that the payer of the lump sum will deduct and account for income tax under the requirements of the PAYE regulations. Nice simple example using a fund of 100,000, someone aged 59 wishes to take the full fund as a lump sum. They'll get 25,000 tax-free with £75,000 taxed at the marginal rate. If this is the only income they have, they will fall into higher rate tax and get £82,568 after tax. The tax calculation is as follows, and I'll pop it up on the screen. In essence, the net payment is the £57,568 plus the £25,000, the tax-free bit. It's about £82,568, which has a really nice calculator that you can use to calculate this for you. As usual, the link will be down below, and you can add in any other taxable income that you might have. So it's just a really nice, useful thing to use. If the same person decided that they only wish to withdraw sufficient to utilise their personal allowance, they could take £16,760 UFPLS a year, and they would get £4,190 tax-free, and they would get £12,570 taxed at their marginal rate. It is very likely that emergency tax will be applied to the payments from UFPLS. Scheme administrators may apply emergency tax in respect of all UFPLS payments, even if a tax code is actually held. As such, it's really important to check the tax situation with the scheme administrator prior to drawing any UFPLS. Under the emergency tax code, the amount being withdrawn is treated, and this is the key bit, as if it will continue to be paid each month. although in many cases will actually be a one-off payment. Even though it could be a one-off payment, it will be treated for tax as if you are going to receive that amount every month thereafter. Let's say it's £75,000. Then the tax is calculated as if you will receive that amount every single month. The provider will therefore apply 1/12 of the personal allowance, £12,570 in 2021 to 22, to the payment, and will assess the remaining payment against 1/12 of each of the income tax bands currently in force. Again, Prudential has a really nice calculator that I will pop the link in down below. If you do end up overpaying tax, then it is possible to reclaim this via HMRC in the same year. Otherwise, HMRC will calculate whether you have overpaid or underpaid tax in the following year. But obviously just bear in mind that there will be a delay between when you receive your net payment to when you're able to get the overpaid tax. Very quickly, I'll just give you an overview of small pots, or properly called small lump sum. This is where you have small pensions from which you then have the ability to take them as cash lump sums, basically a maximum of 3 small pots of £10,000 each. A small pot payment can be made from any arrangement, whether the rights are uncrystallised or comprise a pension in payment, irrespective of the overall value of the individual's pension's worth. Up to 3 small non-occupational pensions, personal pension plans, etc. can be commuted under small pots payments, but there's no limit on the number of occupational pensions that can be taken under small pots. To allow the payment of small pot commutation, the following conditions need to be fulfilled. The individual has to reach the minimum retirement age of 55, or satisfies the definition for ill health, early retirement, or has a protected early pension age. Each payment must not exceed £10,000 at the time it's paid. For non-occupational pension schemes, the payment must extinguish all member benefit entitlement under the arrangement. For occupational or public service pension schemes, the payment must extinguish the member's entitlement to benefits under the paying scheme. Taking these under small lump sum rules, the same tax position applies. And one of the key benefits of utilising small pots or small lump sums is that it isn't a trigger for the MPAA, so your annual allowance isn't reduced down to £4,000 when you take a small lump sum or a small pot. And in addition to this, it isn't considered a benefit crystallisation event, so therefore these amounts taken in this manner are not tested against the lifetime allowance. In this case, we're assuming the personal allowance has been used up. So here's a little example. 25% is tax-free and 75% is taxed as income and added to your taxable income. Here's a nice quick example. Pension 1 is £9,000, pension 2 is £8,500, pension 3 is £9,500, total of £27,000. In terms of tax, this would be tax-free cash of £6,750, balance taxed at marginal rate, assuming total income does not exceed the basic rate band, is 20%. 20,250 minus the 4,050 equals £16,200. Total extracted is 6,750 plus 16,200 equals £22,950. Thanks, and see you again soon. Bye bye.